The economy's got that uh-oh energy again. And before you start panic Googling, should I sell my stocks? Hold up, because here's something most people don't realize. By the time the news announces a recession, it's usually been happening for 6 to 12 months already. Yep, the economy's been sneezing long before the headlines start coughing. That's why it pays to spot it yourself. When everyone else's alarm goes off, you'll already be out the door. And today, I'll show you exactly how economists actually spot a recession before it hits. No PhD or crystal ball needed, just a few charts that quietly scream the truth before the media does. I call them the 3+1 indicators. Yeah, I know, sounds like I failed counting, but trust me, by the end, you'll see exactly why. First, what even is a recession? It's not when the financial news says the vibes are off. It's when the economy actually shrinks. Jobs, income, spending, and production all head south together. Technically, it's confirmed by the NBER, the official economic scorekeepers. But remember, they only confirm it after the fact. That's why watching these indicators yourself gives you a massive edge. Because when the crowd starts asking, wait, are we in a recession? You'll already have seen it coming a mile away. Let's start with what the NBER actually looks at, what economists affectionately call the Big Four indicators. Yeah, the Big Four. I didn't name these things, okay? Think of it as the economy's combo meal. 4 main ingredients: employment levels, are people losing jobs, industrial production, are factories slowing down, real personal income, are paychecks buying less, real manufacturing and trade sales, are businesses selling less stuff? If even 2 of these start slipping, economists get nervous. If all 4 go red, that's not a slowdown. That's the economy taking an unplanned nap. They're like the body's vital signs. When your pulse, temperature, and blood pressure all crash together, you don't wait for the obituary. Historically, every US recession has shown weakness here before or during the downturn. They don't predict, they confirm. But these charts usually flash red months before the media panic hits. You can check all 4 together on the Federal Reserve's Fred dashboard, basically the economy's version of a fitness tracker, except it counts layoffs, not steps. Next up, the leading economic index, or LEI. This one's your car's check engine light. It blends 10 early warning signals, from stock performance to jobless claims, basically all the little hints the economy gives before it coughs. When most of those signals point down for months, that's your early warning. Historically, it's dipped before every major US recession since the 1950s. Right now, as of October 2025, the LEI has fallen about 2.8% over the past 6 months, a sharper drop than earlier this year. So, the engine's not on fire, but it's definitely coughing in traffic. It's not perfect. It gave false alarms in 1967 and 2015, but when it drops this consistently, it's worth watching. Now meet the Sahm rule. It's like your smoke detector, when it goes off, that means the fire's already started. Here's how it works. When the 3-month average unemployment rate rises 0.5% above its 12-month low, a recession has already begun. It's named after economist Claudia Sahm, and it's been accurate for every downturn since 1950, with just one false alarm in 1959. Fun twist, it did flash briefly in mid-2024, but then cooled off as the job market stabilized. So even reliable alarms can chirp when you just burned your toast. Right now, October 2025, it's sitting at 0.13, still quiet. But it's the kind of quiet you keep checking twice. If this video is making the economy finally make sense, hit like and save. Next time the markets get that Sunday scaries energy, you'll know exactly where to look and when to act. Now for Wall Street's favorite crystal ball, the yield curve. It compares short-term versus long-term interest rates, basically how much banks pay you for locking up your money for 3 months versus 10 years. Normally, long-term rates are higher. You're trusting them longer, so you get paid more. But when short-term rates jump above long-term ones, it's called an inversion. That's like the bank saying, we'll pay you more if you trust us less. Weird, right? That's why it's a red flag. Historically, inverted yield curves have preceded almost every recession, But the timing varies. Sometimes it's months, sometimes years. In 2022, we saw the deepest inversion in decades, and yet here we are in 2025, still standing. So treat it like a yellow light, not a red one. The market's saying something feels off, slow down, but not hit the brakes. That makes up the 3+1 indicators. But let's throw in a bonus, the Vibes Index, also known as consumer confidence. This one's not official, but it's very real. Because if people feel broke, they act broke. They stop spending, delay purchases, and since consumer spending drives about 70% of the US economy, those vibes can become very real data. So when confidence tanks, watch out, because small fear turns into big trouble. Now before we wrap this up, this is the 1% Map Recession Watch List, a free dashboard you can open on TradingView. These are the exact indicators economists track when they're watching for signs of a slowdown. First up, the unemployment rate. When it starts rising quickly, especially by 0.5% or more above its recent low, that's a warning that job losses are building up. The key is the rate of change, not the exact number. Next is total employment, or non-farm payrolls. If this line flattens or turns down, it usually means businesses are slowing their hiring, one of the earliest signs of a cooling economy. Then comes industrial production, the factory side of the economy. A steady decline here tends to confirm that output and demand are both weakening. Inflation matters because high prices eat into real incomes. But more importantly, inflation drives Federal Reserve policy. When inflation runs too hot, the Fed raises rates aggressively, and that tightening often leads to recessions later on. This one's famous, the yield curve, or the difference between 10-year and 2-year Treasury yields. When this line dips below zero, called an inversion, it's predicted nearly every US recession since the 1970s. The last inversion began in 2022, but we haven't seen a full recession yet, showing it's not perfect. Many economists also watch the 10-year minus 3-month spread, which has been even more reliable. This is the weekly economic index from the New York Fed, a real-time pulse of U.S. economic activity. When it trends downward for several months, it's a strong early signal of slowing growth. And finally, the S&P 500 and NASDAQ. When both start falling while unemployment is climbing, it usually means markets are already pricing in recession risk before it hits the headlines. You can explore all of these charts free on TradingView, links in the description. Plus, I've added the official data sources like FRED, the New York Fed, and the Conference Board's leading index. Follow these signals, and you'll always be months ahead of the news cycle. Here's your cheat sheet. The Big Four show how the economy's really doing. The LEI shows where it's headed. The Sahm rule confirms when we've crossed the line. The yield curve shows what markets think is coming. If 2 or more of these start flashing red, that's your cue to play defense, build cash, lower risk, stay calm. Right now, October 2025, the data says the economy's slowing, not falling. Keep your eyes on the charts to stay ahead, not the headlines, because by the time the news says we're in a recession, the smart money's already moved. Just tracking these few puts you ahead of 90% of the population. Seriously, most people only notice the economy when their boss stops buying free coffee. You don't need to track 20 charts. These few will keep you ahead of 90% of people. If you want to go deeper, I'll flash a few more on screen. PMI, credit spreads, housing permits, consumer sentiment, and more. If you want me to break those down too, hit subscribe and drop a comment below. And definitely watch my next video on Recession Proofing Your Wealth. Because knowing a storm's coming is one thing, but building the boat, that's the real flex. Save this video and share it with that one friend who always comes to you for money advice. You'll both thank yourself later.